Good afternoon, everyone. I'm Raymond Dahlman, and this is Liberty Call for December 9th, 2021. It is a Thursday. Hope everyone's having a great day out there in the interwebs. If it's your first time watching, be sure to like, subscribe, and share with friends and family. And like I said, hope everyone's having a great day. It's, again, probably the second or third day in a row it's been overcast here. And I think I'm going to have to get a refund from the state of Colorado. We're supposed to have sunny days, almost every day of the week. So anyways, and I'm going to try to keep this brief. If you can see the little doggy, that right back here over my shoulder, he wants to go play ball, and he gets quite upset. And he'll slack on his security detail if I don't get him some good playtime. All right, well, let's go ahead and jump into how the market did today. The Dow Jones was down 0.06. Which is basically no change. The S&P 500 was down 0.68%. The NASDAQ down 1.71%. Small caps down 2.34%. The VIX went up 8% to 21.68. So I, again, went up a smidge, but I don't consider that too worrisome at the moment. So let's look across the rest of the markets. Looks like internationals or the Europe was down for the most part. Let's get down here. Asia looks a lot of green. So, kind of a mixed bag as far as the way the day has gone. So, again, pretty quiet right now on Fox Business. They're talking about Russia's military pressure on Ukraine. So hopefully that doesn't turn into a giant disaster. All right. So I have a couple articles I want to go through. This first one comes from Lord Abbott. They are a investment firm that provides investment products, and title is which assets have done well during Fed rate hikes. And with the upcoming with the quantitative easing coming to a close and the bond purchases wrapping up over the next 6 to 9 months, according to the Federal Reserve as of right now, kind of interesting. I've been doing a lot of reading about this over the last few months because I knew this was something that was coming up on the horizon. And, as far as, in a rising rate environment, what is going to do the best? So let's go ahead and dive in. With the U.S. Federal Reserve widely expected to begin their QE tapering soon and inflation running uncomfortably high, higher than the Fed's target, the question for most observers is, when will hikes begin and how quickly will the Fed raise rates? As of mid-November, markets were pricing in 5 quarter-point rate hikes in the benchmark Fed funds rate target by the end of 2023, with persistently high inflationary measures likely to introduce some levels of uncertainty to these market expectations in coming months. Yet, while expectations around the pace of hikes may shift in the coming months, it seems clear that investors need to prepare for a Fed hiking environment. What might this mean for investors? One way to assess potential impacts is to look at history, although past performance is no guarantee of future results. In a previous market view, we looked at how short-term bond rates fared during previous Fed rate hikes. Now we will cast a wider net to look at historical impact on other key asset classes. But first, let's begin our bearings. Figure 1 tracks the changes in the Fed funds rates over the past 3+ decades and the most recent projections for where the rate could be headed. So we can see here, starting in the late 80s, you can see a rate hike went up to 2.25%. Then rates went down again, and then a 3% rate hike from 94 to 95, a 1.75 here from 99 to 2000, a 4.25% rate hike from 2004 to 2006. Oh, those were good times. I could get 4% on my cash sitting in my bank. And then this most recent one from 2015 to 2018 was a 2.25. So, all right. So in this chart right here shows, what the expectations are as far as the projection of interest rates for 2022, 23, 24, and 25. So the expectation is by, 2025 that the projection would be that the Fed funds rate would be about 2.5% if their chart is accurate. All right. So let's dive back in. In viewing the last 5 distinct rate hike periods, we see that the Fed has moved rapidly, as in 1994, and more gradually, such as during 2004 to 2006. To see where the rate may be going in months ahead, the lower panel of Figure 1 shows 4 sets of projections, the actual rate projections, so-called dot plot from Fed board members, a line indicating the median points from the dot plot projections, the rate priced into Fed funds rate futures market for the next 3 years, and the expected Fed funds rates based on the overnight index swaps. We think there are two important takeaways. All projections shown suggest a far less aggressive series of hikes than seen in previous cycles, and market expectations of where the Fed funds rate will be after 2023 are lower than the Fed's own projections, even as market anticipates faster rate hikes than the Fed dot plot over the next 2 years. All right, now that we've mapped out the interest rate landscape, let's turn back to the last 5 Fed rate hike periods and summarize the performance of various segments of the bond and stock markets during each period to assess how markets might react in the coming years. We present this performance in Figure 2. So you can see, from 2-year treasuries, which would be your shorter fixed income instruments, across these 5 different periods, ranging from a low of 0.64% to a high of 3.44%. 10-year treasuries, which you would consider more your medium or on the lower side or the shorter end of your medium fixed income instruments, had a range from -7 all the way up to a positive of 1.67. So it looks like the longer the duration of the fixed income, it appears that just based on this, that the longer the debt goes out, the more harm to your portfolio. Bloomberg aggregate looks like we had the worst performance was a -2.04, and the best was a 3.41. Short-term corporate bonds, again, on the shorter side of the duration, these seem to do a little bit better. Worst performing was 1.84. Best performing was 5.65. Bank loans, these are it's hard to describe. Basically, short-term cash instruments. See, the best one let's start with the worst. Worst was 2.14, and then the best was 9.33. And then when you get in, U.S. high yield, which would be your high yield bonds, those typically pay a very good interest rate because they are have the worst or have the least best credit rating. It's hard to say. The worst was -2.06, best being 8.95, and then the two stock categories, growth and value. Growth stocks, its worst performance was 4.24, best performance was 21.09, and with value stocks, worst was 2.98, and the best was 16.94. So. All right. I'm not going to read through all of this. It's a synopsis of each category. So, but as you can see, across the fixed income stream, you can see where it appears that bank loans were probably your best performing assets across these 5 different periods. Your next best would probably be high yield. You're going to get a better return on high yield, but you also have a greater risk of loss. And then from the equity side, the stock side of things, it appears that value stocks underperformed across, if you were to average this out versus growth stocks. And, what the difference is there is growth stocks typically don't pay a dividend. The anticipation is that the value of the shares are going to grow over time. Because they're investing most of their excess capital back into the business. Value stocks are more your dividend stocks. You get a income from the stocks based on ownership. So anyways, all right. So some interesting information, some food for thought. All right. So I got a couple of articles from investing.com. This first one is White House not weighing oil export ban, sources say, as lawmakers urge higher domestic output. So let's go ahead and jump into this. This was written by Stephanie Kelly and Jarrett Renshaw. And this came from Reuters. The Biden administration is not considering a ban on U.S. oil exports to try and lower gasoline prices. A source familiar with the Biden administration's thinking said on Thursday. A bipartisan group of lawmakers earlier in the day urged U.S. President Joe Biden in a letter not to halt exports. The 8 members of the U.S. House of Representatives said a crude export ban would not help lower gasoline costs, as the White House hopes but instead likely raise prices further by restricting global oil supply and discouraging domestic production, according to the letter seen by Reuters. The Biden administration has been grappling with rising energy costs, including retail gasoline prices, which at one point in November were 60% higher than a year earlier. Prices have retreated since then, or down 10% since November 1st. The White House said last month it would release 50 million barrels from its strategic reserves to lower energy prices and press that OPEC to supply more oil to the world. The letter said the administration should resolve higher prices by removing policy barriers that inhibit U.S. production. I would agree with that. Brian Deese, director of National Economic Council, told reporters on Thursday that oil exports is not an issue we are currently focused on. Let's see. The national price of gasoline is around $3.34 a gallon, up from $2.16 a gallon a year ago, according to AAA. Prices peaked in early November at $3.42, according to AAA data. Congress voted in 2015 to repeal a 40-year ban on exporting U.S. crude oil. Since that year, crude oil exports have skyrocketed 600% to 3.2 million barrels per day in 2020, according to data from U.S. Energy Information Administration. All right. So, well, I personally, looking at the rig counts, which I review each Friday, I think that's probably our biggest problem is just we're not pumping enough out of the ground right now. And, this current administration is not oil friendly. So I think that's probably some of the reasons for some of the restrictions. But, me personally, I'd say get all this crap out of the way. Let people just do business. But all right. The debt ceiling. This article is regarding that. It's titled U.S. Senate Advances Bill to Raise Debt Limit, Avert Catastrophic Default. This also came from Reuters, written by Richard Cowan and David Morgan. All right. The U.S. Congress months-long drive to raise the federal government's $28.9 trillion debt limit and avert an unprecedented default took a step forward on Thursday as the Senate advanced the first of two bills needed for the hike. 14 Republicans joined the chamber's 48 Democrats and 2 independents who caucused with them in voting to end the debate on the first bill, spurring right-wing demands that they boycott any measure, leading to an increase in the Treasury Department's borrowing authority. I'm optimistic after today's vote, we will be on a glide path to avoid catastrophic default. The chamber's top Democrat, Majority Leader Chuck Schumer, said in a speech before the 64-36 vote on a measure he negotiated with Republican counterpart Mitch McConnell to speed passage. Treasury Secretary Janet Yellen has urged Congress to raise the limit before December 15th. Republicans for months have been maneuvering to try and force Democrats to raise the debt limit on their own, seeking to link the move to President Joe Biden's proposed $1.7 trillion Build Back Better domestic spending bill. Democrats note that the legislation is needed to finance substantial debt incurred during Donald Trump's administration. Yeah, of course. When Republicans willingly jacked up Washington's credit card by $7.85 trillion, partly through sweeping tax cuts and spending to fight COVID-19 pandemic. Well, I don't think it's a tax cut problem. This is a government spending problem. They spend way too much money. There's, I imagine, a ton of fraud, waste, and abuse in there. So, if it was me, I'd just let the debt default and call it a day. I'm sick of paying these taxes. So, all right. So I'll go ahead and finish that there. So it looks like they're looks like they're going to go ahead and get this passed and, avert some of the hand wringing that's been going on. So I guess that's good news. All righty. Next article, U.S. households net worth posts smallest gain of COVID recovery. Let's see who wrote this. Doesn't say. Came from Bloomberg. Growth in U.S. household net worth cooled in the third quarter as wealth created by rising home values was eroded by a temporary pullback in the stock market. Household net worth increased by almost 2.4 trillion or 1.7% after a 6.4 trillion jump in the second quarter. A Federal Reserve report showed Thursday, while the quarterly advance was the smallest of the pandemic recovery, net worth still climbed to a fresh record of nearly 145 trillion. Third quarter gain included a 1.4 trillion improvement in real estate held by households, while the value of equity holdings declined by nearly 320 billion. While the rise of Delta variant curbed spending and briefly dented equity prices during the period, the U.S. economy continued to improve. Solid job growth, robust consumer demand, and the biggest company profit margin since the 1950s have driven stocks to new records. Meantime, low borrowing costs continue to fuel demand for homes, pushing up prices. So it's kind of a mixed bag. So it does have to slow down after a point. So we'll see what happens next quarter. So, all right. And the last article I have is one that grinds my gears. I saw this comes from Navy Times. I was snooping around there today looking for the advancement results for my son, who is eligible for E6. So I assume they're probably coming out tomorrow. He said it would be around the 9th or 10th. All right. This article is DOD has no clue how many people it's exposed to toxic chemicals. And being a veteran myself, this means a lot to me. All right. Defense Department officials have said in the past that it may take decades to clean up all the contaminated groundwater surrounding hundreds of military installations known to have used firefighting foam compromised of toxic chemicals. Another issue will be determining what cleanup means. The EPA sets the policy and standards that DOD and military services have to evaluate the safety of their drinking water, but according to the EPA's Inspector General, the agency is sorely lacking its ability not only to identify toxic chemicals, but to evaluate their danger. That makes it difficult to determine what's a safe limit and in compliance with Toxic Substances Control Act, which requires studies on a host of chemicals. The EPA Inspector General's office found that the EPA did not have the internal capacity to conduct even the first set of 10 TSCA risk evaluations in a timely manner. Sean O'Donnell, who is the DOD's acting IG, told a Senate panel on Thursday, despite the reassessment of up to 19 full-time equivalents to help with those 10 evaluations, the EPA still failed to meet the deadline. I am so shocked. The government agency screwed up again? Oh, amazing. O'Donnell's testimony brings into question how the DOD can set goals for cleanup without sound, updated EPA guidelines. Along the same lines, the EPA's drinking water health advisories have not kept up pace with the emerging chemicals of concern. He added, health advisories are important to communicate the risks posed by chemicals, including PFAS. However, we found out that out of 212 health advisories issued by the EPA, at least 75% were issued prior to 2000, with at least 50% being issued prior to 1990. The hearing focused on findings of a DOD IG report released in July, which found that the department hadn't responded to known threats of PFAS contamination, largely because of gaps in oversight by the Pentagon's Emergency Chemicals of Concern Governance Council. The report also found that DOD focused most of its efforts on the chemicals found in aqueous film, aqueous, AFFF, that's what we called it in the Navy. It's a bubbly stuff used to quell aircraft and vehicle fires rather than other potential exposures for military service. DOD officials who testified were not able to say how many service members or their families, civilians, or residents of neighborhoods around installations have been exposed to these chemicals because of the DOD. The department is also not required to inform anyone of potential exposure, though the version of the 2022 National Defense Authorization Act under consideration by the Senate has some language that require at least some notifications. Well, isn't that nice? The government is going to tell you, or right now doesn't have to tell you if they're poisoning you. So yeah, I wouldn't live anywhere near a military base. I mean, I still see posting things from the old base where I was at in Jacksonville. And it is so toxic on that base. I mean, I've seen some of the groundwater reports, and it is, I wouldn't want to live within 10 miles of Cecil Field. So, all right, let's dive back in. I know service members who are concerned about potential exposure can get more information. The Pentagon's acting head of safety and occupational health told lawmakers, I know currently if I'm a firefighter with a question about future health effects that we provide a fact sheet and recommend they talk with their supervisor and supporting occupational medicinal clinic to address their concerns and discuss any additional information or answer questions. Laura Macaluso said during her testimony, we're also collaborating with the VA to address any retired or non-current firefighters in the department. But like many other toxic exposures to service members, the DoD is not prepared to implicitly blame any of its illnesses or any illnesses of known exposure on PFAS, because PFAS exposure is part of everyday life, including from products like Scotchgard and Teflon. It's extremely difficult to distinguish firefighters' exposure to PFAS with their occupational setting, Macaluso said, and to differentiate those exposures from other sources of PFAS. So along with the needed updates to EPA guidelines, as well as better technology to identify and remove PFAS from groundwater, DoD needs its only guideline for determining whether the adverse effects of PFAS exposure are service connected. Yeah, I'm sure they'll find a way to get out of that. I mean, the toxic crap I was exposed to during my time in the Navy, I mean, the engine oil, the hydraulic fluid, highly toxic. I imagine the JP5 that we were drenched in all the time wasn't good for us. And then all the other chemicals in the shops. I mean, it was nasty stuff. So, yes, we were supposed to wear protective gear. Did we always? No, because it was hot as balls, and jack suits and stuff was just not practical. So, all right. Well, that's everything I have for today. See, I've only been rambling for, 21 minutes. Shocking. I can't manage to get this under 10. So, like I said, if anyone needs anything from me, don't hesitate to reach out. You can call, email, smoke signals always work. And, I'll be back tomorrow with the weekly wrap up, and see how patiently that little man right back here, him there he is. See Jake. Hi, Jake. So he's been waiting back there patiently. So now we are going to go throw the ball around and have a good time. So hope everyone has a great day, and I will be back tomorrow. Adios.